What's going on YouTube? Listen up, young elder gang. This is Shalonda Williams, one of Big Mama's daughters, the lawyer and real estate agent at You with Another Banger. Please make sure you like, subscribe, and share this video, fam. I hope this video get at least 100,000 likes. In the following video, you will find history, definitions, scripture information, and best of all, what we Americans have been deprived of from the beginning, the truth. Keep in mind, this content used in this video is intended for educational and informational purposes only. We will give you the total truth as we best understand it today. Be sure to hit that like button, young elder gang. Hit that subscribe button if you're new to the channel. Hit that bell and don't forget to check back with us every day for new content. All right, let's get started. Here's exactly how to start tax lien investing today. So you can be making anywhere from 18 to 36% interest on your hustle game. Now for my beginner hustlers, what is a tax lien? A tax lien is a lien which is imposed upon a property by law in order to secure the payment of taxes. A tax lien may be imposed for the purpose of collecting delinquent taxes which are owed on real property or personal property, or it may be imposed as a result of a failure to pay income taxes, or it may be imposed as a result of a failure to pay other taxes. A lien is a legal claim against your property to secure payment of your tax debt, while a levy actually takes the property to satisfy the tax debt. A federal tax lien comes into being when the IRS assesses a tax against you and sends you a bill that you neglect or refuse to pay it. What happens when the IRS puts a lien on you? A lien secures the government's interest in your property when you don't pay your tax debt. A levy actually takes the property to pay the tax debt. If you don't pay or make arrangements to settle your tax debt, the IRS can levy, seize, and sell any type of real or personal property that you own or have an interest in. A tax lien is a legal claim made by a local tax authority on the assets of an individual taxpayer or business. This arises when they fail to pay their property taxes. A lien works as a form of guaranteed payment of a debt, which, in the case of a tax lien, are the taxes. If the owed taxes are not paid, then the creditor, which in this case could be the IRS, you as the liener or other governmental tax authority, can confiscate the debtor's assets. Understanding the tax lien, I'm going to walk you through this rapid fire step by step so that you can stop putting this off and finally get into this business, because it's not complicated. You just need to act, and I want to make this as simple and direct as possible, so you can start believing in this business, because it's absolutely amazing and the best way to make money in real estate. If a taxpayer gets a tax lien on their property, it means that the taxpayer failed to pay their taxes. Local governments have the imperative to place a lien on a piece of property or assets if a taxpayer does not pay local income or property taxes. A lien does not immediately mean that the property is certain to be sold. The purpose of a lien is to ensure that the tax authority involved has priority over other creditors seeking what is owed to them. Another unique feature of tax liens is that investors can trade or exchange them, and this has the potential to generate more than average returns. This type of investment may be profitable, but they come with a proportionate, if not higher, level of risk. So here's how to do it. Hopefully your pen and paper are sharp. Come back to this video, pause it as you go. The very first thing you're going to do is call your county. You can call your county's tax collector's office for information about tax liens, including auctions, when and where the next tax lien auction will be held, property listings, a list of properties with tax liens that are scheduled to be auctioned, sale rules, details about pre-registration requirements, accepted payment methods, and other sale rules. The county sells tax liens to recoup public dollars spent on abandoned properties. In different states, the tax collector will first sell the tax lien and then the property if the lien isn't paid off. The property owner will receive notices and opportunities to pay the taxes before the property is sold. After the sale, the property owner may be able to get the property back by paying the taxes, interest, costs, and other charges. So that, obviously the county has a website, but you can go poke around and things like that. You can Google the name of your county tax assessor office and get their phone number. A county tax assessor is an elected official who determines the taxable value of all properties in a county. This assessment is used to calculate the amount of property taxes owed and helps fund local governments and schools. All right, so number 1, Google County Tax Assessor phone number. You're going to call them up old school. Plug the landline in, get your fingers dirty. Some people still like to talk on the phone. This is the best way to not have to spend the amount of time you would probably spend going around to each county site. Just go straight to the horse's mouth and get the answers. Okay, you're going to call them up. You're going to ask them, when is the tax lien sale going to be held? Where is the auction going to be held? What interest rate do you guys offer on your tax liens? From there, you want to ask, what time does the auction begin? From there, you want to ask them, where do you advertise for the sale? Is it in a newspaper or on a website? All right, from there, you want to ask them if you can be put on the mailing list, because they'll also go ahead and mail you good old-fashioned mail. You know, go in old school. It's fun to have that stuff from the 80s that we used to do called mail. Now I know we still get mail, so for anybody who's watching who wants to get into tax liens, tax deeds, and make money in real estate with an alternative way other than paying, you know, full market value. But buying properties for 80 to 95% below market value is a steal. Since I've been in this game, I think tax lien is the best way to own a home instead of a mortgage. Go ahead, subscribe to the channel. I got lots of good tips on here, and most people miss out because they're not subscribed and then they don't really learn it in depth like we're doing in this video. Most people don't like the AI voice, but if you listen to me, this is $1 million hustle. So hit that like button, you guys. Subscribe, you're going to be in for a ride because this real estate investment is amazing. Real estate investment is the process of buying, managing, and selling or renting real estate for profit. Investors can make money from real estate through rental income, price appreciation, or both. Real estate is the world's largest asset class, and there are many types of real estate investments, including residential, homes, townhouses, and condominiums, commercial, retail stores, office buildings, storage facilities, and warehouses, student housing, a consistently in-demand investment REITs, real estate investment trusts. A group of investors pool their money to invest in a syndicated project. Investors can also indirectly invest in real estate through pooled real estate investment or REITs. REITs can be purchased as shares on major stock exchanges or through REIT mutual funds or exchange-traded funds, ETFs. Real estate investing can help investors build wealth, increase income, and diversify their investment portfolio. However, the tax implications for investment real estate are often different than those for residential real estate. All right, so you're going to get that old school mail game, just like Big Mama to this day. I still get letters in the mail and auction lists, and it's fun. They come in, you might forget about it. This mail will alert you that an auction is coming up. Me and my team still go into a lot of the smaller counties and will still do this stuff, which is cool because you can make a lot of money. A tax lien auction is a public sale where a local government sells the right to collect a property owner's unpaid taxes to a private buyer. The auction is the final step in the process of collecting delinquent property taxes. The winning bidder pays the most money for the tax lien, which includes the amount of taxes owed plus interest, fees, and costs. The bidder is issued a tax lien certificate, which guarantees that the tax lien will be paid off. Anyone can purchase tax liens, except for city and county employees and their immediate families. There is some risk involved in purchasing tax liens. For example, the property may have other liens that prevent the buyer from taking possession. There may also be unforeseen expenses, such as repairs or evicting the current occupants. If the tax lien certificate isn't paid off within a certain amount of time, the certificate holder can apply to force a public auction of the property. This is called a tax deed sale. When you win a tax lien, you become responsible for paying the tax bill, interest, and fees, and you gain the right to collect on the unpaid taxes. Pay the tax bill. You must pay the full amount of the tax bill, including interest and penalties. Collect on the unpaid taxes. You can collect the unpaid taxes plus interest from the homeowner when they repay their taxes. Foreclose on the property. If the homeowner doesn't pay the taxes, you can start the foreclosure process to take ownership of the property. Receive a tax lien certificate. You receive a tax lien certificate that gives you the right to collect on the unpaid taxes. Earn interest. You may earn interest on the investment if the homeowner pays the taxes. Recoup fees and costs. You may recoup any fees and costs you incurred. Tax liens have an expiration date, and the lien holder can't collect the unpaid balance after the lien expires. Okay, All right, moving along. You need to ask them, do you register the day of the sale or do you pre-register ahead of time? To register for a tax lien auction in your state, you can visit therealauction.com, pre-register at realtaxlien.com to participate in the tax certificate sale or the electronic tax deed auction to view upcoming properties and register as a bidder. Some auctions require a deposit to participate. For example, in Pinellas County, bidders must deposit $200 or 5% of the highest bid for each property. In Polk County, bidders must deposit 5% of the final bid or $200, whichever is greater. What do I need to register? From there, you want to ask them, what form of payment is accepted? Do you take credit cards, cashier's checks, or cash, or do they take checks? You want to ask exactly who to make that check out to is key, remember. A lot of these auctions these days are going to happen online, which is very cool. You can do them from anywhere in the world. So we have people in China, Africa, Japan, Israel, and many other places. Some of our friends are doing this stuff in Idaho or Iowa, depending on where they want to do tax liens. So that is the beauty of this business. A lot of these counties are going virtually over the web online. Now, with that being said, a lot of the smaller counties can have a lot of better deals. There'll be less competition and more profit and more money to be made. All right, so from there you want to ask them, what happens to the tax liens that are not sold at the tax lien auction? Because this is great. Because what happens here, a lot of places that tax lien will go to what we call an over-the-counter tax lien certificate. A tax certificate represents a lien on real property and earns interest at a maximum rate of 18% per year. The cost to purchase a certificate is listed beside each parcel in the delinquent advertisement and includes gross tax, interest, advertising cost, and the cost of the tax certificate sale. The tax certificates that you can go and buy literally right now and start earning that full interest rate, and sometimes they might even have certificates that have been sitting for maybe 2 years, and you can buy them and start foreclosing on that thing within the next couple months. Foreclosure is a legal process that occurs when a lender takes possession of a property to recover a debt owed on a defaulted loan. This can happen when a homeowner stops making mortgage payments or fails to meet other terms of the mortgage. You know that money you spend on snacks and other junk food, you could be buying liens with that. Since I've been in the game, I've done hundreds of these deals, and this is like my 7th year of doing it. All right, so next thing you want to ask is, can I attend without bidding or without going to the auction? Some places you might even be able to mail in your bids. Now, that's a bit old school, but some places still do it. From there, you want to ask them, can you provide me with a list of the property codes? Because sometimes the lien list could just be like a 10-digit code that you have to understand how to decipher, and every county is a little bit different, which is what makes this business excellent. Property codes refer to a system of alphanumeric codes used to categorize and identify different types of real estate properties, often including details like the property's use, residential, commercial, construction type, and sometimes even specific features depending on the local jurisdiction and the property appraiser's system. Essentially, they act as a coding system to classify properties for tax assessment and other administrative purposes. Different regions and property appraisers may use their own unique property code systems, so the specific codes and their meanings can vary. Use case. These codes are commonly used on property tax bills, property deeds, and real estate listings to categorize the property type for valuation and management purposes. Example codes. Residential single-family home might be coded as 0100. Commercial office building could be coded as 0200. Condominium may be designated with a code like 0300. Where to find property codes? Property tax bill. Most commonly, you can find the property code on your property tax statement, county assessor's website. Local property appraiser websites usually have a searchable database where you can look up a property's code using the address. Real estate documents. The property code might also appear on the deed or title commitment for a property. It's not very well understood. We want it to stay that way, and not a lot of people on YouTube talk about it either, because it's not a shiny object and dressed all up nice to be wholesaled, right? Listen up, watch now. From here, what we want to ask them is, if the property doesn't redeem, what is the foreclosure process? If a property doesn't redeem, It means that the owner did not take action to regain ownership of the property within the allotted time frame after a foreclosure sale, essentially losing the property to the buyer at the foreclosure auction and giving up their right to reclaim it by paying off the debt owed on the property. The new buyer now has full title to the property. Key points about not redeeming a property. Right of redemption. Most states provide a right of redemption period after a foreclosure sale where the original owner can still reclaim the property by paying the outstanding debt. But if they fail to do so within this time, they lose the right to redeem. Loss of ownership. When a property doesn't redeem, the new buyer at the foreclosure sale becomes the legal owner of the property. Time sensitive. The redemption period has a specific deadline, and if the owner does not act within that time, they forfeit their right to regain ownership. A foreclosure process is a legal procedure where a lender takes ownership of a property from a borrower if they fail to make mortgage payments, usually involving sending a notice of default, followed by a period to cure the default, and ultimately selling the property at a public auction to recover the outstanding debt. If the sale proceeds aren't enough to cover the debt, the borrower may still owe the remaining balance depending on state laws. Key steps in a foreclosure process. Default on payments. The borrower misses mortgage payments for a significant period, typically exceeding 90 days, triggering a default on the loan. Notice of default, NOD. The lender sends a formal notification to the borrower informing them of the missed payments and their right to bring the account current within a specified time frame. Pre-foreclosure period. A period where the borrower can attempt to resolve the issue by making up missed payments, negotiating with the lender for loan modification, or selling the property. Notice of sale. If the default isn't cured, the lender will file a notice announcing the date and location of the foreclosure auction. Foreclosure auction. The property is sold at a public auction to the highest bidder. Deficiency judgment. If the sale proceeds are not enough to cover the loan amount, the lender may pursue a deficiency judgment against the borrower to recover the remaining balance. Important points to consider. State laws, foreclosure procedures vary by state, with some states having judicial foreclosure requiring court oversight, while others allow for non-judicial foreclosure, where the lender can initiate the process without court involvement. Options to avoid foreclosure. Borrowers can try to avoid foreclosure by contacting their lender to explore options like loan modification, forbearance plans, or selling the property through a short sale. All right, you want to ask them what's the best spot on the county website to go and navigate this stuff if they have that information. From there, you want to ask them, how many tax liens were there last year at the auction and how many people attended? Because if they say, oh, we had 30 tax liens and 50 people attended, that's not a good option to go to. You want to be at places where they're like, we had, 200 to 500 liens and 20 people. Those are good places because the previous year's tax auction will be a performance indicator of the one coming up. Now we're going to get into more of what this tax lien is about. How does tax lien investing work? To do tax lien investing, the following events must take place. 1. A homeowner or landowner defaults. To trigger a tax lien on a home or piece of land, its owner must fail to pay the property taxes on it. 2. The local government issues a tax lien certificate on the property. The city or county where the property is located then places a lien on the property and issues a tax lien certificate on it. Should the property owner still fail to pay the property taxes owed and any interest, then the local government can foreclose on the property. 1. The local government sells the tax lien at auction. Once tax lien certificates are placed on defaulting properties, a tax lien auction is held. 2. Investors make bids at the auction. There are 2 ways to make bids on the tax lien certificates. Investors can bid based on the cash amount of the tax lien certificate, the interest rate that bidding investors are willing to accept. If the bids are cash offers, then the highest bidder wins. In the case of interest-based bids, the investor willing to accept the lowest interest wins the bid. The lower the interest rate, the lower the potential profit they can make on the property. 5. The investor pays the taxes owed. Investors who win bids at a tax lien auction are responsible for paying the tax bill along with any outstanding interest or fees. 6. The winning bidder takes possession of the tax lien certificate. The investor who wins a tax lien certificate at the tax lien sale or auction gets ownership of the certificate, but not necessarily ownership of the property. The winning investor has the right to take complete ownership of the property only via final foreclosure. For the original owners to recover their home or land, they must repay their tax bill and any outstanding interest to the investor who holds the tax lien certificate. 7. The property owner is given a deadline for paying their outstanding taxes, interest, and fees. At this stage, the property owner is given a redemption period, a specific amount of time in which they must pay the new investor or face foreclosure. 1. The property owner pays the taxes owed or has their property foreclosed. On the deadline date, these are the possible outcomes. The property owner pays the outstanding property tax, interest, and fees, thus recovering their property. The property owner doesn't pay what is owed, and foreclosure proceedings start. When you win a tax lien at auction, there can be an expiration date in which you must initiate foreclosure proceedings. If you fail to initiate the foreclosure process, you can lose the right to collect on your tax lien investment. Despite the recent rise in foreclosures, most homeowners pay the taxes, interest, and fees owed and avoid foreclosure. What is a tax lien certificate? This is a legal document that serves as proof of a lien placed on a property, which can be either a home or piece of land. The lien certificate lists the details of the property, including its unpaid taxes, penalties, and fees. Tax lien certificates are generally sold at a public auction, conducted online or in person, arranged by the penalizing state authority. Typically, bidders must make a deposit and register before participating in the auction. Tax lien certificates do not transfer ownership of the property, only ownership of the property's tax debt. Some states use alternate terms to refer to tax lien certificates, such as tax executions, certificates of purchase, and tax sale certificates. Where do you find tax liens for sale? You can look up tax lien sales or auctions online. Some states will have their tax offices put up notices and lists of the liens on their website. You may see entire sections of their official websites devoted to these auctions. A good example is how Washington, D.C. handles their tax lien auctions online via what they call over-the-counter tax sales. Not all states put up tax lien auctions. Some states, like Texas, for example, do not sell liens to the public. They only auction off property that's already been foreclosed. Tax lien investing pros and cons. As with any type of investment, tax lien investing has its share of benefits and drawbacks. Here's a rundown of both. The pros. Some of the pros involve a high profit for a small investment with the potential of earning property. Let's take a closer look at these benefits. 1. Small initial capital outlay. In many cases, you don't need a lot of money to start on this form of real estate investing. Even as a beginning investor, you can start with a few hundred or a few $1,000s for buying tax liens. 1. Potentially high rate of return. Most of the profits from a tax lien investment come from the interest on the delinquent tax that property owners must pay. Interest rates vary from state to state, but you can get higher returns in places like Florida and Alabama. The maximum interest rates are 18% and 12% respectively. Do remember that if you significantly reduce the interest rate you're willing to get when bidding, that reduces your profits. 1. You can own property for a small investment. There's a chance you can end up owning the property if the owner fails to pay the outstanding taxes, penalties, and fees. This means that you get to foreclose on the property and claim ownership. When this happens, you have the option to sell the property at a hefty profit or convert it into a rental or investment property. The cons. The downside of tax lien investing includes added expenses that come with foreclosure. These types of properties can be costly and problematic. Let's go over each of the drawbacks. 1. Foreclosure can be costly. When the owner fails to pay the outstanding taxes and penalties on their property within the redemption period, you get to own the property. As beneficial to you as this may sound, the foreclosure process can be expensive, both in terms of time and money. 1. Tax lien investing is not for everyone. Do not discount the potential emotional toll of foreclosing on a property. It takes a different sort of investor, certainly one who isn't into ESG investing, to have absolutely no issues with foreclosure. Remember that foreclosing on someone's home can mean rendering a family homeless. Foreclosing on someone's land can mean taking away both someone's home and livelihood. 1. Foreclosed properties can have more problems than benefits. Investors who didn't do enough research into the properties they foreclosed could discover they can be more of a headache than a good investment. as in the case of the foreclosed properties in the subprime mortgage crisis of 2007 to 2010, many of the foreclosed properties were left to deteriorate until 2014. 1. You could be stuck with a property nobody wants. Some property owners could decide to not pay the taxes on a piece of property that they need to dispose of. For instance, a piece of land that's only 2 feet wide and 4 miles in length is useless to put a home or business on, and is better disposed to avoid paying its property taxes. If you bought the lien on this and foreclosed on it, you'd be stuck with the same problems as the original owner. Or worse, a lien worth a few $100s could shackle you to a property that demands larger amounts in property taxes. Even if the tax ends up as a small amount, that money could have funded better, more lucrative investments. Keep in mind also that there is no secondary market for tax lien certificates, so it can be very difficult to offload if it turns out to be a bad investment. Make sure to look behind the liens and do the necessary research on the properties they're attached to before buying. 1. You need to have money on hand. When an investor wins a bid on a tax lien, they must pay the tax bill along with any interest and penalties within a very short period. Although this can be a relatively small amount, it must usually be paid within 1 to 3 days. With regards to the average annual returns on these investments, note that these can vary due to several factors. Interest rates on liens are not standard. Not all states offer them, and they can vary widely. Dividends on REITs also vary widely due to the different types of properties within them. As of 2023, average real estate returns of 9.5% was from commercial rental properties, while the 10.6% return is from residential rental properties. Maximize the benefits of tax lien investing. Despite its drawbacks, tax liens can still be viable. They can be used as a means of further diversifying your portfolio, and if done properly, can give you quick and potentially significant returns. For more liquidity, some advisors would suggest adding this to a portfolio that offers reliable, regular returns such as REITs. To maximize its benefits, investors should do their due diligence and make sure that the ROI via the interest and principal payments is worth it. Avoid investing in a lien that is more likely to result in foreclosure proceedings and burden you with a non-performing asset. Before you decide on investing in a tax lien, consult a financial advisor who is well-versed in dealing with this kind of investment. Property tax liens are an investment niche that is overlooked by most investors. Purchasing tax liens can be a lucrative, though relatively risky business for those who are knowledgeable about real estate. When individuals or businesses fail to pay their property taxes, the municipalities or other government bodies that are owed those taxes place liens against the properties. Rather than pursuing the cases further, the government auctions off the liens at real-world or virtual auctions. These claims on collateral are also exchanged among investors who hope to generate above-average returns. Through this process, the municipality gets its taxes, and the investor gets the right to collect the amount due plus interest from the debtor. The process rarely ends with the investor seizing ownership of the property. A tax lien is a claim the government makes on a property when the owner fails to pay the property taxes. Liens are sold at auctions that sometimes involve bidding wars. If you need to foreclose, there may be other liens against the property that keep you from taking possession. If you get the property, there may be unforeseen expenses such as repairs or even evicting the current occupants. How can I invest in tax liens? Investors can purchase property tax liens in much the same way actual properties are bought and sold at auctions. The auctions are held in a physical setting or online, and investors can either bid down on the interest rate on the lien or bid up a premium they will pay for it. The investor who accepts the lowest interest rate or pays the highest premium is awarded the lien. Buyers often get into bidding wars over a given property, which drives down the rate of return that is reaped by the winning buyer. Problems to look out for. Buyers of properties with tax liens need to be aware of the cost of repairs along with any other hidden costs that they may face if they assume ownership of the property. The new owners of these properties may have further legal hurdles, possibly including the need to evict the current occupants with the help of an attorney, a property manager, the local police, or all three. Steps to take before bidding. Anyone interested in purchasing a tax lien should start by deciding on the type of property they'd like to bid on. residential, commercial, undeveloped land, or property with improvements, the city or county treasurer's office will know when and where the next auction will be held. The treasurer's office will also know where investors can find a list of property liens that are scheduled to be auctioned and the rules for how the sale will be conducted. These rules will outline any pre-registration requirements, accepted methods of payment, and other pertinent details. Tips for tax lien buyers. Buyers need to do their due diligence on available properties. In some cases, the current value of the property can be less than the amount of the lien. Investors can analyze risk by dividing the face amount of the delinquent tax lien by the market value of the property. Higher ratio calculations indicate greater risk. It's important to check for other liens on the property that will prevent the bidder from taking ownership of it. Every piece of real estate in a given county with a tax lien is assigned a number within its respective parcel. Buyers can look for these liens by number to obtain information about them from the county, which can often be done online. For each number, the county has the property address, the name of the owner, the assessed value of the property, the legal description, and a breakdown of the condition of the property and any structures located on it. Don't invest in tax liens with the expectation that you will get ownership of the physical property. About 98% of homeowners redeem the property before the foreclosure process starts. How to profit from a lien. There are about 2,500 jurisdictions, cities, townships, or counties that sell public tax debt. Investors who are interested in locating tax lien investing opportunities should get in touch with the local tax revenue official responsible for the collection of property taxes. While not every state provides for the public sale of delinquent property taxes, if the state does allow public auction of the unpaid property tax bill, investors should be able to determine when and where these taxes are published for public review. Property tax sales are required to be advertised before the sale. Typically, the advertisements list the owner of the property, the legal description, and the amount of delinquent taxes to be sold. The property owner must repay the investor the entire amount of the lien plus interest, which varies from one state to another, but is typically between 10% and 12%. If the investor paid a premium for the lien, this may be added to the amount that is repaid in some instances. The repayment schedule usually lasts anywhere from 6 months to 3 years. In the vast majority of cases, the owner is able to pay the lien in full. If the owner cannot pay the lien by the deadline, the investor has the authority to foreclose on the property just as the municipality would have. This rarely happens. Investors need to become very familiar with the actual property upon which the lien has been placed. This can help them ensure that they will be able to collect the money from the owner. Beware of neglected properties. A dilapidated or abandoned property located in a rundown neighborhood is probably not a good buy, regardless of the promised interest rate. The property owner may be unable or unwilling to pay the tax owed. Properties with any kind of environmental damage, like hazardous material deposits, are also undesirable. Responsibilities of lien owner. Lien owners need to know what their responsibilities are after they receive their certificates. Typically, they must notify the property owner in writing of their purchase within a stated amount of time. They are usually required to send a second letter of notification to them near the end of the redemption period if payment has not been made in full by that time. Investing passively through an institutional investor. Given the amount of research and due diligence involved in tax lien investing, it's worth considering investing passively through an institutional investor who is a member of the National Tax Lien Association, NTLA. Approximately 80% of tax lien certificates are sold to NTLA members. To secure membership through NTLA, applicants must pass a background screening process to ensure compliance with the NTLA Code of Ethics. Members must also pay member dues of varying amounts based on membership type. Members can participate in member-only webinars, earn a certified tax lien professional certification, and use the association's online directory to connect with other industry experts. Disadvantages of investing in property tax liens. Although property tax liens can yield substantial rates of interest, investors need to do their homework and perhaps to take our new courses before wading into this arena. Tax liens are generally not appropriate for investors who have little experience in or knowledge of real estate. Investors are advised not to purchase liens for properties with environmental damage, such as former gas station sites where hazardous material was dumped. Tax liens can expire. Tax liens are not everlasting instruments. Many have an expiration date after the end of the redemption period. Once the lien expires, the lien holder becomes unable to collect any unpaid balance. If the property goes into foreclosure, the lien holder may discover other liens on the property, which can make it impossible to obtain the title. There's big competition. Many commercial institutions, such as banks and hedge funds, have become interested in property liens. They've been able to outbid the competition and drive down yields. This has made it harder for individual investors to find profitable liens, and some have given up as a result. However, there are also some funds now available that invest in liens, and this can be a good way for a novice investor to break into this arena with a lower degree of risk. If you pay someone's property taxes, do you own the property? Investors who buy tax liens rarely seize ownership of the property. In most cases, the lien holder and the property owner reach an agreement on a schedule for repayment of the amount due plus interest. Seizure of the property is a last resort when the property owner is unwilling or unable to pay the debt. How does a tax lien sale work? 29 states, plus Washington, D.C., the Virgin Islands, and Puerto Rico, allow tax lien sales. Every state uses a slightly different process to perform its tax lien sales. Usually, after a property owner neglects to pay their taxes, there is a waiting period. Some states wait a few months, while other states wait a few years before a tax collector intervenes. After this, the unpaid taxes are auctioned off at a tax lien sale. Once the lien has been transferred to the investor, the homeowner owes the investor the unpaid property taxes plus interest. Where can I find tax liens for sale? You can call your county's tax collector directly to find out the process for buying tax liens. Some counties advertise the dates and the process on their websites. When counties list auctions on their websites, they will provide information about the properties up for auction and the minimum bids for each property. What happens to a mortgage in a tax lien sale? A lien stays with the property when it is sold. Prior to 2017, tax liens used to remain on the previous owner's credit report. However, all three credit bureaus implemented changes that no longer reported civil judgments starting in 2017. By April 2018, all tax liens were removed from all credit reports. Property tax lien foreclosures occur when governments foreclose properties in their jurisdictions for the delinquent property taxes owed on them. Property tax liens are superior to other liens, so their foreclosure eliminates other liens, including a mortgage lien. Homeowners with delinquent taxes typically also have outstanding mortgage debt. After purchasing a tax-foreclosed property, if you discover that there is a mortgage lien on it, it should be removed by the county in which you bought it. The county will discharge the lien based on the tax sale closing documents. If this does not work, you can also contact the lien holder to have it removed. In every state, after the sale of a tax lien, there is a redemption period during which the owner of the property can try to redeem the property by paying the delinquent property taxes. However, even if the owner is paying their property taxes, the mortgage holder can foreclose on the home if the mortgage is delinquent. Are IRS tax liens public record? If a legal claim is made against your property in order to satisfy a tax debt, the IRS will file a notice of federal tax lien. This is a public document and serves as an alert to other creditors that the IRS is asserting a secured claim against your assets. Credit reporting agencies may find the notice and include it in your credit report. The bottom line, property tax liens can be a viable investment alternative for experienced investors familiar with the real estate market. Those who know what they are doing and take the time to research the properties upon which they buy liens can generate substantial profits over time. However, the potential risks render this arena inappropriate for unsophisticated investors. Without the proper research and understanding of the real estate market, an investor could easily end up with a property that doesn't get redeemed by the owner, in the form of them paying their taxes to you with interest, and that has no value. That low-value property will then ultimately end up as the property of the investor. For those interested in investing in real estate, buying tax liens is just one option. Buying a home in foreclosure or buying a home at an auction can also be valuable investment opportunities. If you are still interested in property tax liens, it is recommended that you consult your real estate agent or financial advisor. Get personal advice when you need it most. Discover the best financial strategy for your unique goals and find investment opportunities that can help maximize your income. Vanguard Personal Advisor allows you to receive personalized support from experienced financial advisors and access to services that can help you maintain your portfolio. Find out how you can access personal financial advice and start talking to an advisor. Subscribe, thumbs up, click the link below the video. Thanks for watching. Appreciate it. We'll see you on the next banger. Peace.